If you've attended other sessions, you've been introduced to the 3 stages of financial wellness. If this is not familiar, check out the Money Milestones course, which explores the stages in detail. We consider this workshop a Financial Safety Stage 1 course. First, I'd like to mention that this workshop focuses on loans taken by the student. There are also loans taken by parents for children attending college. Contents specific to parent loans won't be covered in this particular session. In our time together, we'll cover some of the basics of student loans, tips for assessing your current loan status, and we'll show you how to build a plan to manage and eliminate your student loan debt. Finally, we'll leave you with some other resources you may want to explore on your own. Student loan debt nationwide is approaching $1.8 trillion. In a typical year, student loan debt grows 6 times faster than the nation's economy. The debt is spread across nearly 44 million borrowers. Among types of consumer debt, student loan debt is second only to mortgages. First, it's important to understand what type of student loan debt you have. Loans are either federal or government issued or private bank issued. Most of the almost $1.8 trillion of outstanding student loan debt is federal debt with an average balance of over $37,000. While the total balance in private loans is lower, the average debt per borrower is higher. Federal student loans are made by the government with terms and conditions set by law. Stafford loans, financed by the Department of Education, are the most common type of student loan. There's 2 types of Stafford loans, subsidized and unsubsidized. Subsidized loans are offered to students facing financial difficulties. While in college, the government will make the interest payments on these loans. Unsubsidized loans typically require an interest payment from the borrower even while they are enrolled. The interest rate on federal loans is usually fixed, which means it doesn't change over time, and federal loan rates are often lower than those offered by private lenders. For both subsidized and unsubsidized loans, payments are typically deferred while you are at least a half-time student, although an interest payment is likely required in the case of unsubsidized loans. PLUS loans are federal loans available to the parents of enrolled students who are listed as dependents on their parents' tax return. PLUS loans have no maximum amount and are intended to cover fees like room and board, which aren't typically included in standard financial aid packages. If you have multiple parent or student federal loans, you can consolidate them into a single loan with a single payment through the Direct Consolidation Loan Program. This is offered through the Department of Education. We'll dive into consolidation in just a little bit. Finally, you may want to set up a repayment plan, including programs that are income-based. Private loans are made by private organizations such as banks, credit unions, and state-based or state-affiliated organizations. And they have terms and conditions that are set by the specific lender. Private student loans are generally more expensive than federal student loans. The biggest thing to know about private loans is that they're all different. Some allow payments to be deferred while you're in school, others will require payments right away. Interest rates are typically variable, which means they fluctuate over time, and the rates may be higher or lower than federal loan rates depending on the lender. These loans are not subsidized, so you are responsible for all of the principal and interest payments. They typically cannot be consolidated into a single loan, but can be refinanced in many cases. And finally, you'll want to check with your lender about options to postpone payments or create a repayment plan. While the options may be limited, they are worth exploring, despite the fact that they're less common with private loans. In general, we would say that federal loans are more flexible, given options to consolidate, select from various repayment plans, including programs based on your income, eligibility for deferment or forbearance, such as those offered during the COVID pandemic, and similarly, the possibility of loan forgiveness. Private loans can be easier to obtain, and since they're offered by private institutions, you may be able to shop around for the best interest rates. Also, you may not have to complete the FAFSA application, which makes these loans an option for those who are not eligible for federal programs. On the flip side, though, the terms are usually more limited and more strict. If you find yourself in a financial bind, a private lender is less likely to work with you to find a solution. If you aren't certain whether your loans are federal or private, you can visit the National Student Loan Data System, where you'll find a list of all of the types of loans you've received. Next, it's important to know what the current status of your loan is. Each of these statuses has different rights, responsibilities, and options associated with it. The status determines whether or not you need to make a payment now and whether or not interest is accruing. Also, different statuses can last for a different amount of time. Let's walk through each one quickly. First, when your loan is in repayment status, it means payments are due and that you are not delinquent in making those payments. During the grace period, payments are not due. The grace period usually lasts about 6 months after you leave school, graduate, or drop below half-time student status. All federal student loans qualify for a grace period, but private lenders may not offer them. Keep in mind, you can make payments during the grace period to start paying the loan down and avoid interest that may be accruing. Deferment is the period of time when you can pause your payments. Deferment can last up to 3 years. This can be a good option if you have a federal subsidized loan and can't afford to make the payments now, but will be able to in the near future. If you need a longer-term solution, you might look into a modified repayment plan, like the income-based solutions available for some federal loans. Forbearance is a period during which you do not have to make payments. Since interest still accrues in forbearance, this probably isn't the best option unless you can't pay your loans and don't qualify for deferment. An income-based repayment plan is probably a better option if you won't be able to make your payments for an extended period of time. When your loan status changes to delinquent, it means you've missed one or more payments. After a prolonged period, your loan status will change to default. At this point, your loan will likely be sent to a collection agency. Federal loans generally default after 270 days, but private loans are likely to default sooner. Depending on your loan type, you may face wage garnishments, tax refund seizures, or legal actions if you fail to act. However, most lenders will work with you, especially if you reach out right away and begin paying the past due amount. Okay, now it's time to make a plan to manage and eventually eliminate your student loan debt. Like most money matters, dealing with student loans is a long-term proposition, so patience, planning, and persistence are essential. Speaking of long-term planning, building and protecting your credit score is an important step in eliminating your student debt. When it comes time to consolidate or refinance, your credit score will have a lot to do with determining your interest rate. The higher your interest rate, the larger the portion of each monthly payment that goes towards interest. This means less will be applied to paying down your balance. So the lower the better when it comes to interest rates. And when it comes to getting that low rate, the higher the better as it relates to your credit score. We have a workshop called Understanding Your Credit, which takes a deep dive into this particular topic. If you have multiple loans or perhaps have student loans and credit card debt, you'll want to create a debt management plan. At the same time, you're building up your credit score. The goal of a debt management plan is to ultimately pay off the debt, but the initial focus is on making payments on time and maintaining forward progress, even if that progress feels slow. You'll want to start by creating a list of the essential details of each of your loans, including the type of loan, the payment status, the interest rate and loan balance, and the lender or servicing company. With your list of loan details, it's time to select a management method. The most important factor in managing debt is motivation. As with most things, we're each unique in what motivates us. There are two common approaches to paying down debt. They are the snowball method and the avalanche method. In the snowball method, you pay off your smallest debt first, which is great for folks who are motivated by small victories or checking things off of a list. Organize your debt balances from smallest to largest. Make the minimum payment on each debt. Then make an additional payment on the smallest balance. When you pay off that debt, add its minimum payment and the extra payment to the next smallest balance. In the avalanche method, the gratification is less immediate. You focus on the debt that has the highest interest rate and pay that off as quickly as you can. When the biggest balance or highest rate is paid off, you apply the additional payment to the next largest balance. The method is motivating for folks who are focused on the big picture, because in this case, you will pay the least amount of interest over time. But keep in mind, progress is slower because you're tackling the higher debt first. So as long as you can stick with it, the avalanche method will have you paying less interest over time. Keeping track of payment due dates for multiple loans can be a hassle. Not being able to afford all of the payments can quickly put you in a financial bind. So for these reasons, many borrowers simplify the process by consolidating or refinancing their loans. Consolidating is combining several smaller loans into one larger loan with a single lender. Refinancing is restructuring the terms of your loan. Typically, refinancing is done when you can convert a variable interest rate to a fixed rate, or when a lender offers a lower rate than the one you're paying currently. While the end goal is similar, to simplify and lower monthly payments, there are important differences between consolidating and refinancing. First, federal student loan consolidation is only possible through the Direct Consolidation Loan Program from the Federal Department of Education. You cannot consolidate private and federal loans together. However, the Direct Consolidation Program is available for both student and parent federal loans. This program results in a loan with a fixed interest rate and level payments for the life of the loan. You will have two repayment options for the consolidated loan: a standard 10-year repayment plan, or you can apply for an income-driven plan. Income-driven plans can be more affordable, but it can extend the repayment term, typically to 15 or even 20 years. So your payment may be lower, but you'll likely be making payments for a longer period of time. Refinancing is much more flexible. It's a process that can be used to combine both federal and private loans together. You transfer the loan liability to a private lender, often a bank or a credit union. The lender will structure a loan offer for you that may have either a fixed or variable interest rate. The rate they offer will be heavily influenced by your credit score, which is why we suggest you focus on building up that credit muscle before you apply to refinance. Other factors the lender considers are things like your income and the weighted average interest rate of the loans being considered. Also, lenders likely offer a variety of repayment options. Before we dive just a bit deeper into the consolidation and refinancing processes, a word of caution for those of you who might be headed back to school at some point. Especially if you have federal loans. Once you complete a direct consolidation loan, you cannot consolidate again unless you are adding additional federal loans to the consolidation. Okay, assuming your days as a student are behind you, let's take a bit of a deeper dive into consolidation and refinancing. We'll tackle consolidation first. Consolidation is a word you should pretty much attach to federal loans. The end result is you take multiple federal loans and combine them into a single loan with one payment. The interest rate is fixed, so your payments will stay the same over the life of the loan. But sounds simple and straightforward enough, right? Well, not so much. If you consolidate loans incorrectly, you could lose access to forgiveness and repayment programs. So stop before you consolidate Parent Plus loans with other loans. That's because combining them means you could lose access to many income-based repayment plans, which could be detrimental to your finances. Also, stop if you're already working toward loan forgiveness, whether through the Public Service Loan Forgiveness Program, which we'll talk about in a minute, or through a repayment plan. When you consolidate, it resets the clock, which erases your payment history and thus your progress toward forgiveness. Also, keep in mind when you consolidate your monthly payment, the payment may go down, but you may have to pay longer depending on the loan term you received. That might mean you pay more interest over the entire repayment period. You can check the impact of this by completing steps 1 and 2 of the direct consolidation loan application. You can check how consolidation will impact you by visiting the Federal Student Aid website and searching for the direct consolidation loan application. Steps 1 and 2 will give you the comparison. You can also model this in the application demo. You'll also want to consider unpaid interest. When you consolidate, unpaid interest is added to your new loan amount. Then you'll pay interest on this higher balance. Finally, keep in mind that you don't have to consolidate all of your federal loans. If you have special benefits on some loans and not on others, you can maintain those benefits by excluding a particular loan from the consolidation. For example, if you have a federal Perkins loan and your work qualifies you for Perkins loan cancellation benefits, you should exclude that Perkins loan from the consolidation. The good news is you don't have to have all of these answers before you apply. You can explore your situation by visiting studentloans.gov and starting the direct consolidation loan application. You don't have to complete the whole thing. You can just enter your info, assess your situation, and then stop the application process at any time. Also, the Federal Student Aid website has a ton of articles and information on this topic. Refinancing is more straightforward and, quite honestly, more flexible. First, there's a ton of advertising for student loan consolidation. This marketing comes from private lending institutions and is not to be confused with federal loan consolidation. While you can combine or consolidate multiple loans in the process of refinancing, the specifics we just covered regarding the federal consolidation program apply only to that federal program. So don't be confused by marketing language. Refinancing, however, can combine multiple loans that are either federal, private, or both. If you plan to refinance federal loans with a private lender, though, make sure you are not eligible for preferred repayment and forgiveness programs, which are only available on those federal loans. If you refinance federal loans, they are considered private loans and would no longer be eligible for those special programs. You'll want to compare lenders to find the best deals. Start by comparing rates for lenders online. This will require you to submit personal information to be sure to have your loan details handy. Once you find an appealing offer, decide which terms best suit your situation. Do you want a shorter term with higher payments or lower payments over a longer term? Next, apply. It can take several weeks for your application to be processed. During that time, be sure to continue making payments on your existing loans. There are lots of websites and lenders that offer refinancing solutions. One site we recommend is credible.com. Credible is a multi-lender marketplace that allows borrowers to receive loan offers from its vetted lender list. Once you enter your loan information, the program compares your situation to others. If better rates are available, Credible will direct you to lenders, SoFi for example, to investigate refinancing. While reducing payments is certainly helpful, it would probably be better to just have the loan go away. There are a variety of student loan forgiveness programs available. Some programs relieve you of the obligation to repay part of your loans, and others discharge the entire loan. Here's a list of forgiveness programs available for federal loans. The Public Service Loan Forgiveness Program is available if you are employed by a government or nonprofit organization. Forgiveness may be available to you after you've made 120 payments in your repayment plan while working full-time for a qualifying employer. Important note, however, this is a reason not to consolidate or refinance, because if you do, that 120 payment counter resets to 0. Next, the teacher loan forgiveness is available to teachers with 5 complete consecutive years of full-time teaching in a low-income school or agency. If you have a qualifying loan type, you may qualify for forgiveness of up to $17,500. The closed school discharge is available if your school closes while you are enrolled or soon after you withdraw. If you have a Perkins loan, be sure to investigate the cancellation and discharge programs available. While there are some cases where student loans can be discharged after declaring bankruptcy, it's important to know that this is not an automatic process. Finally, many student loans, both federal and private, are forgiven in the event of death. Be sure to check with your lender about this. You can find more information about forgiveness and discharge programs on the Federal Student Aid website, studentaid.gov. Last, be sure to ask your current or prospective employer about any programs they offer to help with those student loans. Some employers will help with payments, and others will provide matching contributions in your 401k if you cannot afford to participate due to student loan payment obligations. But knowing whether there is a program is one thing. Taking action to benefit from that program is another. But putting the effort in can save you money in the future. The last piece of advice I'd like to offer is how to prioritize paying off student debt among other financial goals. If you've attended other workshops, you've likely encountered the financial hierarchy. Similar to Maslow's hierarchy of needs, this pyramid helps you prioritize financial goals that are most essential. With a solid foundation in place, you'll be free to pursue those higher purpose activities. Our Living Debt-Free workshops take a deep dive into this topic, but for now, I'll just point out that there is good debt and bad debt. Bad debt is incurred for purchases that lose value over time. Good debt is for purchases that appreciate in value or improve your financial position. Investing in training and education is an investment in your earning potential, so we consider this good debt, which typically has a relatively low interest rate, placing it here on the pyramid. While making payments on time is necessary and essential to maintaining good credit, aggressively paying down or paying off student loan debt should not take priority over other essential financial steps like building an emergency savings account, saving in your 401k to get your employer match, or as we like to refer to it, free money, or even paying down high interest debt like credit cards. We covered a lot of ground here. So to wrap it up, let's run through 3 case studies. First, meet TJ, who is still enrolled full-time in a post-secondary school. First, TJ should work to limit the amount that he borrows. He should also understand whether any of his loans have a grace period when payments are not due, and be clear on when the grace period ends so he doesn't miss payments. As he approaches graduation, he should spend time preparing for repayment, which will involve creating a spending plan. Check out our Start Smart workshop for more on that topic. Next, meet Michael. He's working for a nonprofit organization. His first focus should be on investigating the repayment and forgiveness programs available to nonprofit and government workers. Finally, meet Ashley, who's working for a large law firm. She has a very comfortable income, but would like to make more progress toward eliminating her student loan debt. She should focus on paying off her private loans first, since interest rates may be higher or variable. Also, private loans are not eligible for some federal programs, including temporary relief, such as that offered during the COVID pandemic. She might consider visiting credible.com to look at refinance options that would result in level repayment plans. There's an endless amount of information online to help you with this important financial decision. There's sites that are specific to situations such as government or nonprofit employees, also sites for private refinancing like Credible. Finally, you can learn a lot by visiting federal student aid website, studentaid.gov.